Hello students, a warm welcome to all of them. I hope you all are doing good and well. So this is the first lecture, and in this first lecture we'll be starting the first chapter, that is the UK taxation system. In this chapter we will be mostly studying the taxation system of UK. How does it work? What are the rules? Which authority manages the taxation in UK? And what is the purpose of the taxation in any country? So we'll be starting with this. So let's start with this chapter, the UK taxation system. So first we'll be starting the purpose of the taxation. So what does this mean? Means that why does a country tax charges on an individual? Why we need to pay taxes? If we will not pay the taxes, no, the government will not be able to run the economy of the country, because government also needs funds to run the country for development, for paying the pensions, etc. And to have a good economy in the country, government also needs receipts, so that they can further invest those receipts in any development project, infrastructure projects, so that the economy of the country will go good. So the first reason why government charges taxes, government needs receipts as income, so that they can use for the development of the country. And the second reason why the tax is charged, for social justice. Social justice means people earning more income needs to pay more tax, people earning less income needs to pay less tax. This is why this is that, because to accumulate and redistribution of wealth in the country. Why? What does social justice means? That redistribution of the wealth in the country. So government tax charges, the government charges taxation on us. So we have studied the two purpose of the taxation: to run the economy, for social justice. What is the meaning of economy? We have studied to run the country, government needs funds. So how government needs funds to run the country, so they will be charging tax from the individuals and the companies, so that they get the receipts and they can use for the development and the for boosting the economy. And the second purpose we have learned, the social justice, means that accumulation and redistribution of wealth in the country. That how it is done: people earning more income will pay more tax, people earning less income will pay less tax. So so this way, the tax authority in HMRC, the tax authority in UK is the HMRC, Her Majesty Revenue and Customs. This is the tax authority which manages everything in UK relating to the payments, where of the how much tax will be paid, when is the tax paid. This is the tax authority that will manage who are the individuals who are paying the tax, who needs to pay tax, what is the tax they are paying. So these all, everything, the whole system of the taxation will be run by the HMRC, that is Her Revenue Customs, Her Majesty Revenue and Customs. So the next, so the taxation year for UK. So each country will be having their taxation period. For UK, the taxation period is 6th April 2023 to 5th April 2024. That is 6th April to 5th April. The tax year is like that. As in India, we have from April to March. So in UK, we have from 6th April to 5th April. And the Finance Act we will be studying is Finance Act of 2023. So the tax year for the Finance Act tax year will be 6th April 2023 till 5th April 2024. So many students will be having a confusion. So we are in the current year of 24 and we are in July. We need to study the taxation of 24 to 25. No, sir. No. This is a blunder, because the tax year runs 1 year backwards. Means now you are in the current year, that is 24. Then if we see, then means we need to study the 24-25 taxation. But tax is paid, the whole year is passed, then the tax is paid, no. So according to that, the tax year will be 1 year back. So we'll be studying, so the year we'll be following is 6th April 2023 to 5th April 2024. As this is the tax year, we have earned the income and will be paying the tax in for this taxation year. So clear with this? The tax year starts from the 6th April to 5th April. Why the tax year is 1 year back, as I mentioned that because the income is earned from 6th April to 5th April. After earning the whole income, you'll pay the tax. No, not that. Okay, how you can pay the tax without knowing your earning for the current year. Now you think I need to pay the tax of 24-25 for 6th April 24 to 5th April 25, but you don't know the tax, the income of yours. No, so you can't pay the taxation. So the tax year be 1 year back will be 1 year back when compared to the accounting year. Many people do not confuse with the accounting year and the taxation year. So keep this in mind that the tax year is 1 year back. Done with this, we'll be moving to the next concept, that is type of taxation. As earlier mentioned by me, that there are two types of taxes, direct and indirect taxes. In the orientation lecture, as I mentioned, there is a direct taxation and indirect taxation. We'll be studying what is the difference between direct tax and indirect tax. As the word direct suggests that we are directly paying to the HMRC. Taxpayer directly pays to the HMRC. When comes to indirect taxes, an indirect tax is collected from the taxpayer via an intermediary such as a retail shop. Any intermediary will be there. Like I am a retailer, you pay me the indirect tax, I will pay to the HMRC. You pay me, I pay to the HMRC. So we have studied the types of taxation. Direct tax means the person or the individual pays directly to the HMRC. In this, we have studied that income tax, capital gain tax, corporation tax, inheritance tax, CGT tax, these all are the examples of direct taxation. Direct revenue taxes are based on income or profits, and more than this is earned and received, the more tax is paid. Income Example include income tax and corporation tax. You earn more income, you need to pay more tax. Direct capital taxes are based on the value of the asset disposed of either through sale or gift. If it is a sale or gift, we need to see which rules will apply the capital gains or inheritance tax. We'll be studying further. These are also the examples of capital gain tax and inheritance tax. As the word direct taxation suggests, means it is directly paid by the taxpayer to the HMRC. Indirect tax means indirect tax is collected from the taxpayer via an intermediary like the retail shop or any showroom, then any shopkeeper, then they collect the tax from the individual, then they pay to the HMRC. The intermediary then pays over the tax collected to the HMRC. An example for the indirect tax is VAT, that is value added tax. Value added tax. We'll be studying further this also, and it is paid to the HMRC. So we are done with the purpose of the taxation, the direct and indirect taxation, and the tax authority of UK. So in UK, as we have studied that direct taxes and indirect taxes are there. So in UK, they have divided the taxation in they have divided the taxation in four types. The four taxations are there in UK. That is mainly under the social justice. We studied, no, social justice means the person who earns more income needs to pay more tax. The person who earns less income needs to pay less tax. According to the social justice, the HMRC has divided the taxation into four criteria. The first one is the progressive taxation. Progressive taxation means as your as the income rises, the proportion of the tax rises. That means if you earn more income, you'll pay more tax. For example, 20% is paid up to 37,700 pounds of the taxable income, and 40% is paid up to 1,25,140 pounds. As your income rises, as your taxable income rises, you pay up to 37,700, you will pay 20%. If the taxable income is more than 37,700 pounds and lies between 125 140 pounds, then you will be paying a taxable the income tax at 40% rate. So the word, from the word only we can guess the answer, that is the meaning. Progressive tax. As the income rises, the proportion of the tax also rises. The second one is regressive tax. And income rises, the proportion of tax paid falls. So don't confuse in this and the progressive tax. Let's take an example for this. Regressive tax means your income is also rising. Your income is rising, but you pay the same tax. If you earn 10 lakhs rupees, means not, if you earn 10,000 pounds, you pay 10 pounds tax. If you earn 1 lakh pounds, you still pay 10 pounds as the tax. So this is an proportion difference. See, I'll take an example. See, if you have a 10,000 pounds income and you are paying 10 pounds tax. If you have 2 lakh pound income, still you are paying 10 pounds tax only. So if you do the proportion of this, no, 10 divided by 10,000 into 100 and 10 divided by 2 lakh pounds into 100 percentage. You calculate, if you calculate the proportion, no, if you calculate the proportion, you will be getting 0.1 percentage. And if you will be calculating for the 2 lakh pounds, you will be getting a 0.005 percentage. See, your income is rising, but you are still paying the same amount of tax, and the proportion of the tax paid is reducing. Here you paid 0.1 percentage of your income, and here you paid 0.005% of your income. So don't confuse with the progressive and regressive tax. Progressive means as your income rises, your proportion of tax also rises. The proportion of the tax, as the example 20 percentage up till 37,700 pounds. Regressive tax means as your income rises, the proportion of tax falls. Let's take an example for this. The tax on a liter of petrol is the same regardless of the level of income of the purchaser. This is regressive tax, as it represents a greater proportion of income for a lower income earned than for a higher income earned. So I told you, whether you earn higher income or whether you earn a lower income, the tax you will be paying will be the same, but according to your income, the proportion of the tax you will be paying in the percentage will be difference. So the types of taxes is progressive tax and regressive tax. The rest two will be studying further. That is proportional tax. Proportion, what is the meaning of the word proportion? Means you are earning some income, pay this much portion of income, pay this much, the portion of income you have earned, no, the income mostly you have earned, pay a portion of tax on that income. Whether you earn 10 lakhs, whether you earn 10,000, whether you earn 1 crore pounds also, no, 1 million pound also, no issues in that. If you earn 10,000 pounds also, you earn 1 lakh pound also, you earn 20 lakh pounds, you need to pay a fixed portion of tax on it. That will be some percentage. So as income rises, the proportion of tax remains constant. For example, the corporation tax is 19% regardless of the company's level of incomes and gains. This has a little bit changes in the current finance act, we'll be studying further. So proportional tax means your tax rate will be the same, your tax proportion will be the same. If you earn 10,000 pounds, you'll be paying according to that percentage, that portion of tax. If you earn 1 lakh, you'll be paying same proportion of tax. But when compared to regressive, what we learned in regressive, that the proportion of the tax will vary. If you are, whether in this in a regressive, whether you are higher rate, whether you earn more income or whether you earn less income, the tax amount you will be paying the same, but the proportion of that, the tax you paid on your income will be different. But in proportion taxation, the tax you are paying on your income, no, will not be difference, the proportion will not be different. If you calculate the same percentage on, if you calculate the same percentage which you have done in the previous slide, this, on 10 lakhs you are paying 10 pounds tax, and 2 lakhs you are paying 10 pounds tax. If you apply the same rules here, see example will take 10,000 pounds, you are paying 19 percentage interest tax rate, and you are earning 1 lakh pound, you are paying 19 percentage. So 19 percentage on 10,000 is 1900 pounds, and for this is 19,000 pounds. Now you calculate the proportion divided by 10,000 pounds into 100. This will give you 19 percentage. And if you calculate for the 1 lakh pounds income, 19,000 pounds divided by 1 lakh pounds, in this case also you will be getting the same proportion, that is 19 percentage. So first we have studied the progressive taxation, means as your income rises the proportion of the tax also varies. So like here, if it is 19 percentage, then it will be 20, 25. When we came to regressive, the tax amount paid will be the same, but the proportion will be reducing. 19, it will become 10. And when we came to the proportional taxation means the proportion of the tax you are paying on the income will be the same, 19% and 19%. That is, whenever you calculate the proportion also you are paying the same. And the last is ad valorem principle. This means a tax calculated as a percentage of the value of the item. For example, 20 percentage VAT on most goods sold in UK. Ad valorem principle means whatever is adding a value or which has a value, and on that you are paying an tax. And the best example is VAT, and as we know VAT is an indirect tax. So ad valorem principle says means the taxation is paid on the value of the item, not on your income, not on anything, whatever is the value. Now if you are purchasing any clothes, for example 1000 pounds, on that 1000 pounds you need to pay the tax. So we have completed the types of taxation under the social justice. Now we'll be studying the types of taxes in UK. In UK, what are the types of taxes in UK? As in the orientation session, we have discussed that we'll be studying 5 key areas, and mostly those are only the taxes we need to study in this taxation paper. The first one is the income tax, payable by individuals on their taxable earning. Example, employment income, self-employment or employment income. Self-employment means trading income, he is doing some trading or running a small shop or doing some small business. And investment income. Income tax is payable by individuals. The national insurance contribution, this is also a type of tax, payable by individuals who are either employed or self-employed on their earnings. Also payable by business, that is sole trader companies, in relation to the employees. Here the employee also need to pay, the employer also need to pay, and the person who is self-employed, he also need to pay. So national insurance contribution, it is a type of contribution. So first we have studied the income tax calculation, which is payable by the individuals on their taxable earning. National insurance contribution, payable by individuals on their earnings, will be studying further. We have a whole chapter on this. And the capital gain tax, as the word suggests, capital, that is payable by an individual on the disposal of certain types of capital assets. Capital assets include land, building and shares, and can also include smaller items such as antiques. Means we'll be studying like wasting chattels. We have this chapter will be studying antiques. Capital gain tax means, what is capital gain tax? Capital gain tax, as in orientation session we have discussed that this is a taxation on the sale of land, building, shares, as these all are capital assets. Then the next is inheritance tax, payable by a personal representative on the value of the estate of a deceased person. Deceased person means you are getting something in will, or a person dies, then the following estate, that is all the assets or whatever assets he have left during at his death, will be transferred to his personal representative, like his grandson, his children's. So that person will be paying the inheritance tax on it. Also payable in respect of certain gifts during an individual's lifetime. We'll be studying this, as we have a whole 3 to 4 chapters are there in the inheritance tax. We'll be covering that also. Then corporation tax. Corporation tax, as the word corporation means companies, payable by the companies on their incomes and gains. Value added tax, payable on the supply of goods and services by the final consumer. As in India we have GST. We have GST. As we are paying GST in India, no? So in UK we need to pay value added tax, that is VAT. So what are the types of taxes? Income tax payable by individuals. National insurance contribution is a contribution by individuals on their earning, depending on what earning they are earning, what is their earning. Capital tax is the tax on the capital assets. Inheritance tax is the tax when you are inheriting something from a deceased person. Corporation tax is payable by the companies on their incomes and gains. Value added tax is paid by final consumers. So we have done with the types of taxation, we have done with the types of tax in UK. Now the tax laws which are made, from where does the tax laws comes, or what is the source of these tax laws? So first is the legislation, the means like parliament. The parliament makes the laws, parliament makes the laws. This is law and therefore mandatory for all the people to pay, mandatory for all people, mandatory, whether you can't deny this. There is a law in the country which you are living and you are residents, then you need to pay that tax because this is the law of that country. You can't escape from this. Tax legislation is normally updated each year by one annual finance act, but that follows from the proposal made by the chancellor of the, sorry, I had a little bit of the connection issues. So we'll be starting again with the source of tax laws, statute or the tax legislation. So statute law means the legislation, the parliament or the government brings in the tax rules and we need to pay the tax. We can't miss or we can't escape from this. And every year there is a new finance act and it is proposed by the chancellor and in his annual budget statement. Like in India we have the finance minister, every year we have the budget, and during the budget we'll be having the finance act for the coming tax year. Same will be the case in UK also. Statutory instruments are issued where detailed notes are required on any area of the taxation legislation. Whatever the rules and the regulations or the tax rules which are issued by the parliament will be given in an instrument and we need to follow those. So first is the legislation makes the tax rules. The second is the case law. If you are, the parliament has given the tax laws and tax rules, and if any issues is there identifying whether this will apply or this will apply, then you can refer this, the taxation rules, in the case laws. Case laws refers to the decision made in the tax case brought before the courts. Means this case law you would have studied in your F4 chapter, your the F4 paper, the law paper. Case law means if any case is going in the court or Supreme Court, then they'll give a judgment on it. And if any same or related case further comes to the Supreme Court, then the laws which were given by the Supreme Court in the earlier case, the same laws will be applying here also. So case law means now, if there are example I'll take that. Now if any income tax rule is there and we are not able to understand it properly, we have some issues in that. So and the matter has gone to the court, the court will say okay, this is that this. So HMRC, case law means the HMRC will be saying, the if we go to court means the HMRC only will be solving the taxation laws. They will say that student, the for the taxation people, that you need to follow this. The meaning of this rule is that this, you need to follow this much taxation rate on this much amount, and this transaction will be treated in this case. And in further, if there is same type of transaction or same type of transaction, the same rules which the HMRC has specified, those rules applies. Like certain interpretation of the tax law should be applied. Often the case challenges current tax legislations or argues a certain interpretation of tax laws should be applied. Means the current legislation which law is made by the parliament, if any arguments are there or any interpretation is, and if you are interpreting if you have 2 to 3 ways of interpretation, you will be having a confusion whether to apply this or that. If there is any interpretation and if you pay low tax, the HMRC will lose its revenue. So you can use the case laws. First will be the legislation. The parliament will be issuing the laws, and if any interpretation or if you have any issues in understanding the tax laws, the HMRC provides guidance also, like in the form of case laws, or HMRC will provide guidance also. As the tax legislation can be complex to understand and open to misinterpretation, further guidance is issued by the HMRC in order to explain how to implement the law, give their interpretation of the law. So HMRC will give guidance what does the rule say and how it will be implemented, and give a interpretation of the law. The main types of guidance are provided by the HMRC in the form where they'll provide these guidance on their websites, leaflets, internal manuals, statement of practice, and extra statutory concession. They may publish on their websites. Leaflet means brochures they'll be having on the in their brochures they'll be uh, giving the interpretation and how to implement the law. Internal manuals will be for the tax advisor or the taxation people who are dealing with the taxation issue in the UK. And statement of practices and extra statutory concession. Extra statutory concession means sometimes the HMRC provides guidance on that. If you pay some charity, you will not be taxed. If you invest in the if you open an individual saving account, you will not be taxed on a particular amount and particular interest you receive from it. So these are the sources of tax law. First is the statute law, that is tax legislation which the parliament or the finance act is brought every year, every year or annually it will be brought by the finance minister of that country. The statutory instruments are issued, and the notes and all the PDFs and the notes will be provided by the legislation on the website of the government, UK government website. Case laws and the HMRC guidance. If we have any issue in the interpretation of the law, HMRC will be providing us guidance on the in the following way through websites, leaflets, internal manual, statement of practices, extra statutory concession. Extra statutory concession means some benefits like there is no tax on the charity amount you're paying in UK, etc. So we'll be dealing with the next topic, that is double taxation agreement. So double taxation agreement, first I'll give a small introduction and a small example. Examine that I am a businessman in India, and I am having a business in India, and here I'm earning and I'm paying a 20% tax on the income I have earned in UK. And further, that amount earned I will be taking to UK for my further, I'll be starting a new branch or something. I'll be or investing in a new business or something. So the UK department, the UK HMRC department will say, okay, you have earned income in India and you have brought here, and this is also your income, so you need to pay here also tax. So then they'll say you need to pay a 30% tax. So that businessman, if as a businessman you will think, no, then you need to pay tax here in India 20% and in UK 30%. Then 50% of his amount is 50% of his income has been paid in tax. So he'll think that, okay, why to do business then? If I'm earning and I'm paying 50% to the government, then I need not do a business also. Simply earning and paying 50% of my income to government is a very bad idea. So to solve these issues, each country will be having with other country double taxation agreement. This means that if an individual earning and paying tax at 20 percentage in India, and if he carries that income to UK and is paying 30 percentage, then what will be the double taxation treaty means? Okay, he has already paid tax in India 20 percentage. Then the Indian government and the UK government will have a double taxation agreement that the income which is bringing from India to UK, you only tax on the above taxation rate. That is that he need to pay 30 percentage tax in UK, and he has already paid 20%. So the difference is 10 percentage. You only charge 10 percentage so that he'll be having a relief. So this is double taxation agreement. Agreement between most countries have been established to decide how a particular individual company should be taxed. Some details of how these operates are given below. The double taxation agreement. These are also known as bilateral double taxation treaties. Such treaties takes Such treaties takes precedence over domestic UK tax laws and either exempt certain overseas income from tax in UK or provide relief where the tax is suffered in two countries on the same income. As mentioned by me, as I've already mentioned you that a person who will be earning income in India and paying 20% tax and carrying that income in UK and he'll be paying tax at 30 percentage. So he'll be saying that I paid 50 percentage. So what is the relief here? So what is the relief here? Provide relief where a tax is suffered in two countries on the same income. Provides a relief. What is the relief? 20% relief is getting and he only needs to pay 10 percentage extra in our case. Where no such treaty exists, the UK system still allows for reliefs to be given where double tax is paid. Double taxation relief for individuals and companies are not examinable for F6. This will be examinable in ATX, your professional papers, if you opt for professional papers. So double taxation agreement is an agreement between the countries where they will be having a that they'll be providing relief to a person so that he invest or he carries his income to other countries and he invest in other countries also. Tax avoidance and tax evasion, these are the two most important topics for the exam. You can get a 2 marks question, OT question for 2 marks in the section A, so please concentrate on this. Tax evasion and tax avoidance. So the word tax evasion, the term tax evasion summarizes any action taken to avoid or reduce tax by illegal means. Tax evasion means you are not paying the tax only, you are evading. How you will evade, how the tax evasion will be done means you will not show the income only. You will say, okay, you have earned 10,000 income. You will show that I have only earned an income of £1,000. This is very wrong and this is illegal. If you will be found by the HMRC doing these malpractices, you will be penalized and you need to face the criminal and civil proceedings as per the HMRC guidance. So what the word tax evasion means? Tax evasion means avoiding taxation, avoid or reduce taxes by illegal means. The main forms of tax evasions are suppressing the information, example, failing to declare taxable income to the HMRC. You are earning £10,000 and you are saying as a HMRC that I have not earned any income only. Submitting false information, example, claiming expenses that have not been incurred. So this will be learning. Tax evasion means you're hiding your income source. You're hiding your income source so that you need not pay your tax. This is very illegal to do, and this can be done through surpassing your information, not providing your information to the HMRC, or you are providing false information like that you earn £10,000 and you are saying HMRC that I have earned only £1,000. Tax evasion is an illegal activity and carries the risk of criminal prosecution, fines, and or imprisonment will be there. If you are found that you are doing tax evasion in any illegal activity, as you are doing tax evasion, this is an illegal activity, there is a risk of criminal prosecutions and imprisonment in UK. Now we will be looking at the verb tax avoidance. Tax avoidance is using the taxation regime to one's own advantage by arranging your affairs to minimize your tax liability. So tax evasion means it is an illegal activity. You are hiding your source of information. You do not want to pay tax on it, so you are hiding everything. So tax avoidance is opposite to it. Tax avoidance means that you are using the taxation rules only, but you are using and minimizing in such a way that you pay a minimum tax liability in the current year. It is also called as tax planning. So you can do tax planning. See example that you are selling a house in UK and you get a gain of 2 lakh pounds, and on that you need to pay the capital gain tax. But what you'll do know, okay, this year I have a huge income, I have a huge capital gain, already I have sold 2 properties, I have a huge capital gains. So what I'll do, the property which I was planning to sell this year, I'll postpone it to the next year. so that my tax get reduced and my gain get reduced, so the tax amount will also get reduced. So tax avoidance means tax avoidance is using the taxation regime to one's own advantage by arranging your affairs to minimize your tax liability. This is also referred as tax planning, as you can plan your tax, you can do tax planning so that you pay a minimum amount. It is legal. Tax evasion was illegal, but tax avoidance is legal and does not entail misleading HMRC. Example, making tax saving by investing in ISA, individual saving accounts. This will be learning in a second chapter. What the individual saving account means that for a certain amount, the interest which you get on that amount will be free. You need not pay the income tax on it. The term is also used to describe tax schemes that utilizes loopholes in the tax legislation. So you'll be having some loopholes. Okay, I'll do this, I'll do that, and you'll be paying a lower taxation. But the tax planning you are doing, no, this not must not be aggressive. If it is very aggressive, no, then HMRC will look into the matter. So whenever you are doing a tax planning, the tax planning must not be aggressive, so that the HMRC, for HMRC there will be a loss of or will lose loss of revenue. The tax planning should not be aggressive. We have done with the word of tax avoidance and tax evasion. Tax evasion is illegal way to reduce or the tax avoidance is the legal way, such that you are properly planning your tax, you are properly planning your tax so that you pay the minimum tax amount. So GAAR, what is the GAAR? GA, first we'll go through the slide, then I'll give a explanation. Specific tax avoidance schemes have been targeted by HMRC with an anti-avoidance legislation to counter the tax advantages gained by the taxpayer. So in UK, the HMRC identified that there were some tax avoidance schemes which were used by the individuals so that they pay a minimum tax amount. But those tax schemes were very aggressive, and those were against the HMRC law, and those were mostly, like you can say, like loopholes, and it was very aggressive, so that HMRC used to have a great loss in their revenue. So in that case, the HMRC has introduced the GAAR, that is General Anti-Abuse Rules, disclosure obligation regarding anti-avoidance tax schemes, requiring the declaration of the details of the schemes to the HMRC. HMRC says that when you're doing the tax planning and the tax schemes which you are using, no, you need to disclose it when you're filing your return. What is the tax scheme you are used, what is the amount, and everything you need to disclose it. And the general anti-abuse used to counter artificial and abusive schemes were arrangements which cannot be regarded as a reasonable course of actions are put in a place deliberately to avoid tax. As I mentioned, this GRR is the General Anti-Abuse Rule. This was introduced by the HMRC so that in the tax avoidance, I told you that if you do some aggressive planning, if you do aggressive tax planning, HMRC will have a loss of revenue by some schemes. So because of that, the HMRC told that whatever tax schemes you are using for your tax planning, you must disclose to the HMRC during your filing. And a general anti-abuse, what is the main role of bringing the general aim of bringing the general anti-abuse rule is to encounter artificial and abusive schemes which leads to lower taxation or avoiding taxation by an individual. This you need to keep in mind. What is GAR? You can get a question for in the OT questions for 2 marks. So have a thorough reading. No much in this. It is an anti-abuse rule. It is a type of a rule that HMRC says that this has been brought in to force because that HMRC is losing a lot of revenue because of the specific avoidance schemes which individuals are using for aggressive tax planning, and which is not which is legal, but it is very aggressive. To encounter that, the HMRC has introduced the GARR and disclosure obligations regarding the anti-avoidance taxation schemes. Professional and ethics guidance. See, as an individual has done the aggressive tax planning and paid a tax less, no. So because of that, the ACCA told, okay, you are the tax practitioner, you are the person between the HMRC and the individual who is paying the tax, or you are giving, you are planning, or you are giving some guidance, or you are giving some information that you can use this scheme and you can reduce your tax amount at this. So the HMRC says that the tax practitioner should have some professional and ethics guidance, should have some values, some ethics must be there, whether you are accountant, whether you are taxation. So the ethics are ACCA code of ethics and conducts. These are the ethics which will be studying in your professional paper also, and other papers also you would have studied in your BT or the F1 paper. So what are the ethics? Objectivity, professional competence and due care, professional behavior, integrity and confidentiality. Objectivity means members should not allow bias, conflict of interest or influence of others to override objectivity. Objectivity means a person, the tax practitioner should not be biased or should not have any conflict of interest or should not come in the words of the individuals or his clients. Okay, you save me this amount of tax, I'll pay you this much amount. This is, he should not be biased, he must not allow any biasness, he must be very ethical to what work he is doing, and he must not come under any influence of his client. Professional competence due care, members have an ongoing duty to maintain professional knowledge and skills to ensure that a client receives competent professional service based on the current development. Objectivity means he must not come and under any influence. Professional competence and due care means he must be updated with the knowledge and the skills which are required in the current scenario and the current time. As the world is developing, as the economy is developing, the rules and regulations will be changing. So the tax practitioner should be aware of those rules and regulations. Professional behavior, members should refrain from any conduct that might bring discredit to the profession. Means behavior. What should be the behavior of the tax practitioner? He must be his behavior must be in a professional manner. He must behave like a professional. He must not do anything that discredit the professional. He must not, for example, whenever we have an interview, wherever we go to company, we must have a dress code. Will be whenever we will be joining our office, we'll be having a dress code. We need to follow that. Why we are following? That is a professional behavior. Okay, this has to be done, and this is the code of in the organization, and we to follow. If you follow this, you will be having a good impression. Okay, that he's a tax profession, he's a tax practitioner. So this all include your how you behave, your dressing sense. So means tax practitioner, accountant, any profession needs to act in a professional behavior. Integrity, members should act in a straightforward and honest manner in all professional and business relationship. The tax practitioner or the accountants or the auditors need to be straightforward and honest. They should not lie. Confidentiality, members should, confidentiality means whatever confidential information I have about the client, I must not disclose to any person. I must not disclose to any person for any to third party that I am getting some benefit. I'll disclose to the third person. I'll getting some or the other benefits. So if I give the confidentiality data of my client to some other person for my benefit, is very wrong. He need to be confidential about the information of his client. Members should respect the confidentiality of the information acquired as a result of professional and business relationship and should not disclose any such information to third party, excuse me, unless they have proper and specific authority or there is a legal or professional right or duty to disclose it. The tax practitioner, he must have confidentiality, he must maintain the confidentiality of the information of the his client, but he can breach this confidentiality in two cases where there is legal or professional right or duty to disclose. Example, money laundering, when he is doing some illegal means, the court or the authority is asking, then we need to disclose why he is doing this. Confidential information acquired as a result of professional and business relationship should not be used for the personal advantage of the member of the third parties. As already mentioned by it, a person should not for his own benefits. He should not make misuse of the information. He should keep confidential. He should maintain the confidentiality of the information which he has got from his client. Confidentiality means maintain means the information which you have got from your client must be confidential with you. You must not provide, or you must not give to any third party for your own advantage. What are the ethics, code of ethics we have learned? Objectivity means he should not be under any influence. He should not allow any biasness. Professional competence at UK means the member must be upgraded with the knowledge and the professional skills and knowledge which are required in the current scenario. Professional behavior means his behavior must be in a professional manner. Integrity, member should act in a straightforward and honest manner in all the professional business relationship. He must be straightforward and honest. Confidentiality means maintaining confidentiality of the information which he gets from his own client. Now we'll be moving to the next slide. Dealing with HMRC. See, if a person in UK, if your client is there, your client have done some any error and he's not disclosing to HMRC, then how you will be dealing with the HMRC? We have some criteria how we'll be doing, what we need to do if he is not following our orders, what are the suggestions we need to give. We'll be studying it. It is important to ensure that the information provided to HMRC is accurate and complete. Whatever information we are providing to the HMRC must be accurate and complete. A member must not assist a client to plan or commit any offense. If a member becomes aware that the client has committed a tax irregularity, then they must discuss it with the client and ensure proper disclosure is made. Example would include not declaring income that is taxable, claiming relief to which they are not entitled, not notifying HMRC where they have made a mistake, giving rise to an underpayment of the tax or an increased payment. So dealing with the HMRC means HMRC says whatever the taxation, the the taxable income you have earned and you are submitting your return, you need the return must be accurate and complete. And as a tax practitioner, as a member of an ACCA, you should you should not allow the your client to do any malpractice by not disclosing the information or etc. So how you will deal with this if your client is doing some malpractices so that the HMRC is losing revenue and there is an underpayment of tax? Where a client has made an error, it will be necessary to decide whether it was a genuine error or a deliberate or fraudulent act. The UK taxation system published, you can refer in the Kaplan publishing book. This is that. So we'll be discussing where a client has made an error. It is necessary to decide whether the client this was a genuine error or it was deliberate or fraudulent. Means whether in by when filing the return he forgot it, it was a genuine error, then it is allowed. If he deliberately does not disclose it, no, it is a very huge problem. Once an error has occurred, has been discovered, the member should explain to the client the requirement to notify HMRC as soon as possible and the implication of they not doing so. The client has made an error. Okay, it was genuine deliberately. Okay, we got to know the reason. Once the error has been made, no, as a member, we need to inform the client. Okay, that you need to notify to the HMRC as soon as possible. If you not, if you do not notify the HMRC as soon as possible, there will be taxation implications and the penalties. What are the implications if you do not notify? There can be civil or criminal procedure or tax implications, etc. Depending on as HMRC will decide that. Should the client refuse to make a full and prompt disclosure to HMRC, the member must write and explain the potential consequences and consider whether the amount is material and if it is, whether they should continue to act for the client or not. Now a client has made an error, will decide whether it was a genuine error, deliberate, etc. Then once an error has been discovered, we'll say the client, okay, you need to notify the HMRC, and if you not, these will be the implications. And after that also, if a person is not If the client, your client is not disclosing, you need to consider whether the amount is material. If the amount is material, and you must request the client, and you must say the client that you need to notify the HMRC, and you must need to pay the tax amount on the income which is pending, or if you are not paid. If not, implications will be uh, implications will be done by the HMRC. They'll imply some other rules, and you will be penalized, or you will be, or penalty will be levied on you. If the client still refuses, or if you are giving an information, you are suggesting your client to do this, and you're giving in writing that okay, you need to notify, and you need to, if you not notify, you will be under some implications. If still the client is not, if still the client refuses to make a full disclosure, the member should cease to act for the client. As a tax practitioner, if I'm informing my client that you need to disclose to the HMRC and you need to pay tax, if still my client is refusing to make the full disclosure, then the member, as a member, I should cease to act for the client. Must then also write to the HMRC informing them that they have ceased to act for the client. You must say that okay, I will not be acting for the client. I will not be acting for the. You should cease. You will not be acting for the client, and you need to inform this to the HMRC, but without disclosing the reason why. Must then consider their position under the money laundering regulation. So the person has made, your client has made an error, you will inform him, okay, you must notify to the HMRC and you must pay the tax. If not, you will be having some implication. If your client still refuse to make the disclosure, then as a member, I need to resign him. I must not act for the client, and I must provide in writing to the HMRC that I am ceasing to act for the client. And when you are informing to the HMRC that you are ceasing to act for the client, you should not mention the reason, because in OT questions you will be getting for 2 marks. The statement will be saying, okay student, you, if you are dealing with the HMRC, you need to write with the HMRC and that you are seizing for the client, disclosing the reason. You must not disclose the reason. You must only disclose that I am ceasing to act, I am not further acting for the client, I am not, and I'll not be treating him as my client, and I'll not be acting for him as a as a tax practitioner. So as this, the last point is very important. If the client still refuses to make a full disclosure, the member should cease to act for the client. Must then also write to HMRC, must then write informing that they have ceased to act, but without disclosing the reason. They must not disclose the reason why they are ceasing to act. No disclosure. Keep this in mind. What are the money laundering issues? As we have studied in the case of this tax evasion, see, we have studied under the tax evasion that money laundering can also be here. No, 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 not here. Money laundering arrangements. Where we have studied money laundering? 1 minute, students. Okay, under the professional ethics. Sorry, my bad. Here, confidential. He must maintain the member. We must not disclose the we must maintain the confidentiality of the information which we get from our client. That is the meaning of confidentiality. And when we can breach the confidential, when there is legal or professional right, the member has the legal or professional right. For example, when the client is doing any money laundering practices or is under the act of money laundering, so we'll be seeing the money laundering issues. Money laundering is the term used for offences including benefiting from or concealing the proceeds of a client. What is money laundering means? No, money laundering mostly means that you are hiding your source of income. You are not paying the tax on it. You are mostly hiding the source of your income, like black money. We say no, kala dhan in India. So black money means money laundering. You are using your, you are not showing the source of income, and you are rotating the money in further bank accounts and moving to some other countries and through some other transaction, and after that you're purchasing some asset. So this will be under the money laundering issues. So for money laundering, let me take the example of, no need, we'll be learning the money laundering issues means you are hiding your source of income. At present, keep in mind, hiding the source of income. Source of income. All businesses within regulated sector must appoint a money laundering reporting officer within a firm. The MLRO will decide whether a transaction should be reported to the National Crime Agency (NCA). Where a report is made, the client should not be informed, as this may amount to tipping off, which is an offense. A report to NCA does not remove the requirement to disclose the information to HMRC. So if a client is under any money laundering issues, how we need to deal it? So what the HMRC had told, that what they have told, that each business or each company or each company must have a money laundering reporting officer. That money laundering officer report, the money laundering officer will decide whether the transaction needs to be report to the National Crime Agency. For individuals, directly you need to report to the National Crime Agency. Now I am a tax practitioner, my client has done is under some money laundering, I have identified that he is doing some money laundering. Then what I will do, no, I will report to the firm's office, that is money laundering reporting officer. The company for which I am a tax practitioner, I'll be saying the money laundering officer, then they will decide whether the transaction needs to be reported to the National Crime Agency. But for example, take, I am a tax practitioner and I'm helping for the taxation for individuals. Then directly, if the person is found under the money laundering, then you must directly report to the National Crime Agency. And if you are dealing with any company, you are a tax practitioner and you are dealing with a company, then you need to report to the money laundering officer of that, of your client, that is your company. The company which you are dealing, that company will need to have a money laundering officer, you need to report him. Then he will decide further whether to report to the National Crime Agency or not. Where a report is made, the client should not be informed, as this may amount to tipping off, which is an offense. So if you are saying to the money laundering officer, okay, here the client is under any is doing any money laundering, so you must not inform to the client, you should not say your client, okay, that you have reported to the money laundering. If you do this, no, it will be a tipping off. Then your client will get to know and he will do the changes which he need to do, so that he will not come under the money laundering regulations. The report to NCA does not remove the requirement to disclose the information to HMRC. So, as a tax practitioner, you found your client guilty under the money laundering. Then you need to, if he is a company individual, you need to report to the money laundering officer. For individuals, National Crime Agency. And after reporting also, you need to report to the HMRC also. Okay, need not that, okay, I report to the money laundering officer and National Crime Agency, I need not report to the HMRC. No, 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 it is very wrong. You need to report to the HMRC that you are ceasing to act to the client, and you should not disclose the reason. If you disclose the reason, it will be against the ethics, that is confidentiality. And where the report is made, the client should not be informed, because if you inform the client, it will be tipping off to the client and it will be an offense, because he'll get to know, then he'll make the changes and get rid of it. So the last topic in the first chapter, dishonest conduct of the tax agents. See, as a tax agent, I'm not honest with my job, I'm not doing the work properly, I'm doing some dishonest work, then there is a civil penalty of up to 50,000 pounds for the dishonest conduct by the tax agents, not by the individuals, that is by the tax agent. In case where the penalty exceeds the minimum penalty of 5,000 pounds, HMRC may publish details of the penalized tax agent. So as a tax practitioner, I say my client, okay, you can do this way and you can reduce your tax, but you know that this is an illegal way. If you are found in an illegal way, then there is a civil penalty of 50,000 pounds for the dishonest conduct by you as a tax agent. in case where the penalty exceeds, now the penalty of 50,000 pounds will be decided by the HMRC, and if the penalty rises, excuse me, is more than 5,000 pounds, then the details of the tax agent, as I am a tax agent, example, as I am a tax agent, I have done some dishonest conduct, and HMRC has a HMRC has imposed a penalty on me of 30,000 pounds, you say. As my penalty is more than 5,000 pounds, so what HMRC will do, no, they'll publish my details on their website. Okay, so this tax agent has been penalized this amount, and he has been under dishonest conduct with HMRC. So my brand, my image will be down. So you must act in a honest way, that is, you must integrity, as we have studied in our code of ethics. Integrity, what does integrity say? Dishonest, the person must be honest and straightforward, you must not be dishonest. So we have done with this also. So in today's class we have covered the first chapter, so the UK taxation system. We have seen the purpose of the taxation, that is for the economy, to run the economy, social justice, so that there is accumulation, redistribution of the wealth in the country. Then the tax authority, if UK is HMRC, Her Majesty Revenue and Customs. Then the tax year we have seen, that is 6th April to 5th April. For the Finance Act of 23, it will be from 23 to 24, and the tax year will be 1 year back following the accounting year. Then we have to study the types of taxation: direct taxes, indirect taxes. Direct taxation means directly paying to the HMRC. Indirect taxes means the we are paying to an intermediary like the retail shop, and then that retail shop pays to the HMRC. As the word suggests, indirect, some intermediary is there in between. Then types of taxation: progressive tax, as your income rises your proportion of tax rises. Regressive tax, as your income rises the proportion of tax paid falls. That is, for example, liter of petrol, if you earn 10 lakh pounds, you still pay 10 percentage, 10 pounds tax. If you earn 2 lakh pounds, you pay 10 pounds tax. Then we have seen proportional tax: as your income rises you will be paying a fixed proportion of tax. Okay, whether your income is 1 lakh pounds or 2 lakh pounds, you will be paying some percentage as a fix. That we have seen the corporation tax example, that is 19 percentage. Ad valorem principle, that this will be based on the value of the item, on the value of the item, for example the value added tax. Then we have seen the types of taxes: income tax will be paid by the individuals, national insurance contribution will be paid by individuals, and if he is employed by any employer, then they also need to pay. Capital gain tax is the tax on the disposal of the capital assets. Inherent tax is the tax on the estate which is left by a deceased person, that is, you are inheriting from your grandparents or your ancestors, etc. Corporation tax is paid by the companies. Value added tax is paid by on the goods and services in the country. Source of tax laws, as mentioned by me, from what are the source of the tax laws? The legislation, the parliament will release the finance act every year. As in India we have the finance acts or the budgets. In that, the tax for the next year, for the next tax year, the taxation rules will be published by the parliament. If we have any issues, then we can get a guidance through case laws, or HMRC also will provide guidance through their websites, leaflets, internal manuals, statement of practices. So that what they'll provide the interpretation of the law and how to implement, how to apply, and what is the interpretation of the law which the parliament has issued. Double taxation agreement means two countries will be having a treaty, so that businessman invest in other countries also, so that they need not pay tax of the income they have earned in two countries. If they pay in two countries, then most of the income they earn they'll be paying to the government only. So it will be a very bad for the economy, and the individuals and for individuals will not be planning to start a business in any other country. So double taxation agreements are there to provide relief. And in a double taxation, whatever is the excess only we can collect. See, in India we are paying 20 percentage and UK we are paying 30 percentage. So what is the excess? 10 percentage UK can charge on the income, and India will be charging 10 and 20 percentage, and this 10%, so total 30 percentage. This will be done by both the countries. They'll be having a partnership agreements, the agreement, double taxation agreement. This will be known as bilateral double taxation treaties. Tax avoidance, tax evasion will be illegal ways to reduce the tax or not paying the tax. It is an illegal way. We need to inform to the HMRC, and it will be a how persons conduct is false information or suppressing their information. Tax avoidance is a legal way to reduce your tax, but this must not be aggressive. How this is done? By a good tax planning. Then we have studied the GI, general anti-abuse rule. Why it was brought? Because due to many specific tax avoidance schemes which were aggressively used by the individuals to reduce their taxation by them. Then we have seen professional and ethical guidance. What are the ethics? Objectivity. We must not be under any influence. We must professional behavior and competence. We must be updated with the rules and regulations. We should have a good knowledge of the current surroundings and regulations. Professional behavior, integrity. We must be straightforward and honest. The tax is confidential. We must maintain confidentiality of the information of the third of our client and should not use for our own advantage. When we can breach this confidentiality? When there is legal or professional right to disclose, that in case of money laundering. Then dealing with HMRC, how we'll be dealing with HMRC? Whenever as the data or whatever filing we are doing with the HMRC must be complete and accurate. If it is not complete and accurate and our client has done any error, if our client has done made an error, then we'll inform that okay, we'll see whether it was a genuine error or deliberate. Then as a tax agent or as this, I'll inform him that you need to notify to the HMRC as soon as possible. And the if not, the HMRC will you will be having some implications by the HMRC. So if your client still refuses to disclose the income after informing by the tax agents, then they must inform the HMRC that they are ceasing to act for the client without disclosing the reason why they are not acting for the client. They must not mention the reason, only they must mention that I will not be acting for this client. Money laundering, if a person is hiding the source of the income, then he'll be under the money laundering. And if a person is under money laundering, then as if our client is under falling any under or under money laundering, then if it is a company, we need to report to the money laundering reporting officer of your client. As the company, every company needs to have a money laundering reporting officer. And if it is an individual, they need to report to the National Crime Agency. And after reporting as a tax agent, after reporting to the money laundering and NCA, the money laundering will further see whether the transaction needs to be reported to the National Crime Agency. In case of company, in case of individuals, directly to this. And even if you are reporting to both of them, that is, even you are reporting to money laundering officer, reporting officer and the National Crime Agency, you need to inform to the HMRC. You must disclose to the HMRC. You need to make a disclosure to HMRC also. Also make disclosure to HMRC, mandatory. See, a report to NCA does not remove the requirement to disclose the information to HMRC. You need to make the disclosure to the HMRC that this our client or that the client is under this and I will not be acting for him. I'll cease to act for the client, and you must not disclose the reason. You need not disclose the reason, but when it comes to the money laundering, no, as it is illegal, and then you need to make the we disclose the reason also. Disclose the reason, because as we have studied here, confidentiality can be break in legal or professional right or duty to disclose, that is under money laundering. You must disclose to the HMRC what is the reason why you are not acting for the client. Dishonest conduct of the tax agent. If any tax agent is found of dishonest conduct, then a penalty of £50,000 will be levied on him. and in case where the penalty exceeds a minimum penalty of £5,000, then the tax agent data will be published by HMRC on their website, that this taxpayer has been under malpractices, and our image will be down. So I hope the first chapter was good and you would have understood each and every topic. So this in this first chapter, you have a no rules, you have not studied any rules and anything, only a basic introduction of the UK taxation system. So please do revise the chapter once, and please do solve the questions in the Kaplan study text, the study hub questions, so that you will be having a good idea that how OT questions will be coming for 2 marks. So I hope we had a good session. So good luck to all. Start preparing. Good luck. So we'll be ending today's class. I'll meet you in the next class. Thank you and have a good day, students.